Howdy there, folks. Welcome into the buy one, get two free. 3 videos for me to react to in this one here today. First one up, Yardeni. No recession in sight. The economy is in a rolling recovery. Well, last year we were talking about rolling recession. Now we're talking about rolling recovery. So I want to hear what Yardeni has to say, give my perspectives and opinions on that. Then I want to react to this little, might be the smallest clip we ever reacted to on this channel, a 1-minute clip from Terranova on why he expects more intraday volatility out there. So I want to react to that one. And the last one up here to react to is this one. The opportunity is there to put together a pretty inexpensive portfolio, says this gentleman. So I want to hear what he has to say and kind of give my perspectives and opinions. Appreciate everybody being here as always. Thanks for joining me, folks. New all-time high subscribers, 33,100 plus subscribers. So thank you, everybody. Subscribe to the channel. I appreciate y'all being here as always. And let's jump into this.
Inflation is still on a downward trend, and that the Fed can take the rest of the year off. Let's bring in Ed Yardeni of Yardeni Research. Ed, I don't know that they're going to necessarily immediately say that they're taking the rest of the year off, but it's certainly in wait and see mode. And I guess you're not afraid, as many are, that we're going to get to a sticky place in terms of inflation, and the Fed's going to have to tighten things a little more?
I think we're past the sticky side of things, because if you look at the CPI headline inflation rate, excluding shelter, which includes that annoying component called rent, we get a 2% increase on a year-over-year basis. If you look at the CPI core rate, excluding food and energy, and then take out shelter, you get 2.5%. So we're actually below 3% on these kind of measures. And so it's really all up to shelter, and shelter has been sticky, but I think it's starting to come down, and it's coming down because it's starting to reflect the fact that inflation on new leases has come down sharply. It's actually down on a year-over-year basis, according to apartmentlist.com.
It's true. You'll have others talk about 4.4% annualized wage growth and the fact that we have a lot of these union contracts getting pushed through, and diesel costs can get passed along into core services. However, all that being the case, has the market already kind of gotten to that spot where it's assuming that the...
Let me give some advice. If anybody watching this video, I know a lot of people that watch my channel, you guys own your own homes, right? But for anybody that's watching this video right now and you're a renter, okay, listen up. If your landlord is going up on rent, look around. Because I'm telling you, there's deals that can be had out there in this market right now, especially when it comes to rent. Don't just believe that, oh, you know, they're going up 3%, 5%, 7% on my rent. Oh, I just got to pay it. Don't believe that crap at all. Look around. There's so many new apartment complexes opening up across the United States, especially in a lot of the states and cities that have been growing rapidly. There's a lot of homeowners that are, you know, in terms of folks that are looking to rent their properties that have jumped on the market here recently. So don't just be victim to just staying in one place and assuming like, oh, they went up on my rent. That's what it is what it is. Trust me, look around. You're probably going to be able to find a lot better options and save yourself some money, or spend the same amount of money and get yourself a lot more bang for your buck. Do not be complacent right now, and do not just believe that, oh, rents are going up. Trust me. I rent out 2 of my properties, okay? Trust me. Look around, okay? Look around. You're going to be able to find way more bang for the buck, or you're going to find a way to save money on rent.
It's just about done, and we have the soft landing in place, or is there more upside to be gathered from that being confirmed?
Mike, I've been forecasting 4,600 on the S&P 500 by year end. We got there on July 31st, so we got there about 5 months early. So now what do? I don't really feel like it's appropriate to raise my target here, because valuations are stretched, and I do want to see that earnings kind of catch up with the market. So I think we're going to be kind of trading around this level, just below.
Yardeni's been looking at his own research. I showed you guys, what was that in the, I think on the main channel. I think it was yesterday's video. I showed you guys how rich large caps are trading right now in this market. Arguably cheaper, or excuse me, arguably more expensive right now for S&P 500 large caps than what you were having to pay in 2021. Let that sink in for a moment. And arguably the most expensive you are paying for large cap S&P stocks right now since 2000.
4,600, around 4,600 through year end. And then I think we have another good year next year. But for now, I think that the market has discounted the likelihood that the Fed has finished raising interest rates for now, and that inflation is going to continue to moderate, and that the economy is going to continue to hang in there pretty well.
It is remarkable given that, 1 month into the third quarter, you have the real-time Atlanta Fed estimate for GDP growth pushing 4%. Nobody really accepts that on its face. However, even with that, you have plenty of folks saying deceleration is observable elsewhere. And, we got under 200,000 jobs last month. It's probably headed down from there. In other words, the recession call has mostly been deferred and not taken off the table. Does that make sense at this stage?
Well, I think you've got fewer economists predicting a recession, but you're right. I mean, we're not out of the woods yet. The fact is the Fed has raised the short-term rates by over 500 basis points. The fact is mortgage rates are back up over 7%. So there's still some kind of restrictive policies out there. And we saw that in the Moody's downgrade of the banks. We saw that in March in the banking crisis. And we've seen it in the SLOOS, the Senior Loan Officer's Opinion survey that the Fed puts out. So credit conditions are going to keep the economy from booming here. But I don't think we're going to go into recession. I think we've been in a rolling recession, hitting different industries at different times. I think now we're actually probably seeing something of a rolling recovery, particularly in the goods sector. I think the worst of the recession in goods is behind us. And from here on, consumers are probably going to be a little bit more even in their spending. They've gone on a buying binge in services after their buying binge in goods. Now I think services slows, goods picks up, and then the consumer continues to spend. I mean, consumer spending, according to the Atlanta Fed survey you mentioned, is tracking at 3.5%. And I think a lot of that is, as Steve Litzman has said, a lot of it's because the June number ended up on a strong note, and you're kind of comparing averages over averages. So these are legitimate numbers.
Wall Street frat boys just didn't have enough fun in college. They got a party at the New York Stock Exchange too, apparently. Okay, so right now is it's a great time if you have cash, right? You can get great returns on that cash. It's the best time period to be somebody that holds cash that we've seen in a long, long time. Actually, the best we've seen, it's the best time to hold cash probably since the great financial crisis, right? Because obviously when you're going through a financial downturn, it's great to have cash around because you're able to pick up assets at extremely cheap prices. So this is the most attractive time to be kind of cash loaded since that time period, right? Not a good time to be somebody that has to take out debt. Mortgage rates, personal loans, anything like that, credit cards, horrible. Car loans, okay, horrible time. The worst time in the past 15 plus years to take out debt that we've seen, right? Now, the interesting dynamic in regards to this, right, is if we are to see a recession eventually come, right, let this sink in for a moment. Let's say hypothetically we have a recession in 2024, let's say it hits, right? Say market gets hit hard. Well, guess what? It is also going to be the best time to be cash loaded because you're going to be able to pick up assets for very cheap valuations, right? If that was to play out. There's also a potential that it doesn't play out and this time's different and we don't have that recession, or that recession gets pushed out to 2025 or whatever, right? But it's a really good time to have some cash around, man, because you get great returns right now. And if we set up for a downside scenario, there you go. Boom, you're ready to rock and roll and deploy that money in the market and get some, great assets at some great values. So obviously you don't want to just plan on that scenario, right? Because you're going to miss out on potential gains if this market continues to kind of roar and let's say earnings come in much stronger and the market goes on kind of the next level of a beast run. So you want to kind of take an approach similar to mine, in my opinion, especially if you're a higher net worth individual, which is an approach of I'm buying stocks every single week, I'm cashing up at the same time, and I'm also buying hedges. So in case the stuff hits the fan, it's not like I just have cash around. It's those hedges will print me money. And then I'll be able to flip those hedges into long positions. So that could kind of be a beautiful scenario playing out there. All right, let's react to this 1-minute clip here from Joe Terranova.
Slipping in this market a little bit. It feels as if, the rally attempts have been unwound, and even some of the intraday declines have been picked up. What do you make of the churn?
We seem to have a pattern over the last several weeks where any rally attempt is being met with sellers and reversing intraday. Clearly, post the 30-year auction at 1 p.m., we saw the long end of the curve. Yields begin to spike.
If you didn't get to see those win results, ooh, they were so beautiful. So flippin' flapjack and beautiful. Win. Great name. That's one of those names, you can buy it heavy in a recession. You can buy it heavy now because the stock's trading really, really cheap compared to, historical valuations and considering where their business is at. That's, like I said, there's some really attractive stocks. After all the growth stocks have gone up so much, right? The NVIDIAs and the Teslas and Metas and all those stocks, right? I'm telling you, beneath the surface, there's a lot of great values in this market. A lot of great values. That if you have a 3 to 5 year outlook, there's a lot of money-making opportunities in some, especially a lot of the value and dividend stocks. That's what I'm finding this year. Last year, growth stocks. Oh my gosh, it was the best time to be a freaking growth stock investor that we've seen in a long, long time, right? Discussing valuations everywhere, such great deals. Now, value stocks and dividend stocks, man. That's where I'm putting a lot of my money, is in a lot of these low PE names, right? Even a PayPal. Yeah, it kind of is more of a growth stock, but it trades at value stock valuations. Look at the forward P's at, 10, 11 on PayPal? That's a value stock. So I'm telling you, man, there's a lot of great opportunities in the value and dividend space.
Equities fall back. So, Mike, people could talk ad nauseum about the fact of you could replace the leadership for mega cap technology and technology, but can you really? Because we haven't done that in the last 10 days, clearly. And it looks to me like the price wants to go down and shake the hand of the moving averages. 50 days down at 44.32. It's about time we touch it.
So the yield pressure, do you feel as if that's mostly about we're recognizing there's a lot of supply out here, we're not imminently going to be tipping into recession, or is there something more going on?
Well, I think there's two dynamics. I think there is the increase in issuance. That's clearly leading to a little bit of nervousness. It's less about the Fitch debt downgrade, but there's also this dynamic. The asset management industry is long duration and wants to get longer duration. Hedge funds, speculators, they're short duration, they're short treasuries, so you have a little bit of this battle going on. It's playing out at a seasonally weak period for equities where there's not much liquidity. So you're going to see a lot of intraday volatility in the bond market.
Yeah, that's an interesting thought. And, it's interesting. I was hearing a lot of people are on vacation on Wall Street right now, which makes me think, what the hell, man? These guys are freaking on vacation all the damn time. Didn't they just go on vacation July 4th weekend? Like, they had a big vacation. It's August now. They're going on another big vacation. Next thing you know, it's going to be fall time, and then they're taking November and December off. Like, holy smokes, these guys are on vacation constantly. That's that Wall Street lifestyle, man. I need to get out there eventually one of these days, man. I'm 33 right now. Once I turn 40, you peacing out, man. Going to New York City, starting the fund, and calling it quits, and taking 10 vacations a year like all these other guys do. Holy smokes, that's the lifestyle, man. But in all seriousness, right now the market is the market's waiting for one specific thing. I'll tell you exactly what the market's waiting for. The market is waiting for NVIDIA. The market's waiting for NVIDIA. Everybody's waiting. We've kind of been let down by AI so far. The AMD numbers, the Palantir numbers, even that super micro company, right? Many of these AI stocks that have been kind of booming that kind of are in the AI category, right? They haven't come through with amazing numbers or guidance. They just haven't. And so we've kind of been like, the air's been let out of the balloon a little bit, and now everybody's looking at NVIDIA and like, you guys going to actually come through with those numbers you said you were going to? What about next quarter? What about next year? And so now everybody's kind of focused on NVIDIA, and they're waiting for some sort of confirmation as far as like, oh, NVIDIA doesn't have it like that, or NVIDIA does have it, and maybe this is a little overblown in terms of the pessimism around AI right now. Last video to react to here. The opportunity is there to put a pretty inexpensive portfolio together. I want to hear what this gentleman has to say.
About whether the market is expensive here and we're due for a pullback or even a correction because of it. How do you see it, given the fact that you are this long-standing, formidable value investor?
Well, the way we look at it at Oakmark, the S&P 500 is trading just a little under 20 times earnings. Doesn't look particularly cheap to us at that price. But what's unusual now is after that really strong growth outperformance in the first half, the spread between PE multiples of the expensive stocks and the cheap stocks is getting back up to historically unusually high numbers. So even though the S&P is at 20, we've got a bunch of growth stocks at 40 to 50 times earnings, and then a bunch of value stocks that are still at single-digit multiples. So we think the opportunity is there to put together a pretty inexpensive portfolio.
I want to dig into that a little bit more, but this idea, and we saw it play out last year, and certainly at Oakmark as well, this idea that tech is a value play. Can we say that that dynamic or that chapter of the market has come to a close then?
I don't know that it's really come to a close, but it's certainly not as attractive as it was last year.
Yeah, I mean, of course it's over. Many of those stocks have climbed 100, 200+% from their lows, sometimes even more than that, right? Last year, go back to the fourth quarter, go back to this time last year, and go back to even the fourth quarter of last year, right? You had all the big tech stocks all trading like insane value propositions, right? Meta was a perfect example. Ford P got down to like 11. That was ridiculous on Meta, or maybe even 10. It was silly. It was so silly, right? You had stocks like NVIDIA that got down to Ford Ps of like 20-ish or so. AMD, I think, got down to a Ford P of 18, 20 at the lows, right? You can go, Tesla, you can go through the whole list. Yeah, growth stocks, tech stocks last year, they were trading like value stocks. Like that was a silly time period we were in, and folks that got to take advantage of that, myself and hopefully some of you guys, man, we really we really did it in regards to that. But yeah, those days of those being valued as value stocks are long gone, right? It's a big difference between paying $110 for NVIDIA versus $410.
Last year, we were using alternative valuation metrics that we thought did a better job of identifying value than GAAP accounting did, to buy stocks like Uber at a double-digit free cash flow yield, or Adobe Systems when that was barely at a premium to the market for a great business. And those stocks have performed incredibly well. So they've found their way out of our portfolio, and the replacements tend to be more of these single-digit PE names in the banking industry, insurance sector, energy, legacy media. So those names seem attractive.
More traditional value, if you will. So I guess what are some examples of some of these more recent names that have found their way into the fund?
You know why I'm laughing? I'm just laughing because this gentleman that's speaking right now, I'm just like, man, it's got to be hard to get him to get emotion around anything. Like, holy smoke, because this is no joke. It's like, come on. Oh, gosh.
Well, we've added to positions in Comcast and Charter, single-digit PE multiples. I think investors tend to worry too much about video cord cutting, and we think the companies should be given infrastructure-like multiples for their internet access business. With the banking crisis at the end of the first quarter, we thought that got overdone.
I don't know about that, man. You want to start being priced like AT&T and Verizon? I don't know if you'd want that.
We're able to increase some positions there, including adding names like First Citizens and Truist, where we think the regionals kind of all got painted with the same brush of concern that there'd be deposit outflows. We think both those companies have very strong, well-diversified, transactional-based deposit franchises. We've added in the auto sector to our position in GM, which was a clinker today, but and maybe you could say has been for the past decade. But we think they're finally.
Sir, would you like to go on a date with me? Well, you know, I'm going to have to look at my schedule and see if that's an appropriate action to take.
The end of this stage where it seems like there's always another use for the cash they generate, and finally they'll have an ability to start returning it to shareholders.
Yeah, I do want to go back to financials for a moment, because to your point, there was a lot of throwing the baby out with the bathwater and all the regional bank turmoil, and that hit the broader financial sector as well. Charles Schwab was one of those examples. And
well, when you're throwing the baby out with the bathwater, you want to make sure the baby falls on a pile of feathers. That way the baby doesn't really hurt itself.
I think for me it raises the question of how do you assess the health of these companies and decide what to invest in when there are different metrics and different accounting methods that could be at play and that we know have affected the stocks?
Well, I think we need to look at some of the metrics that GAAP accounting doesn't pay a lot of attention to. like a breakdown of the deposit franchise. How strong is it? How well diversified is it? How much is it transactional based versus investment based? Because when interest rates go from 0 to 4 or 5%, we all get more careful about how much money we leave in our bank accounts that aren't paying much interest income. I think also on the asset side of the balance sheet, need to pay attention to the duration of the assets and like how far those assets have fallen in value because interest rates are high.
Man, what do I think about this portfolio? I'll tell you what I think about it. No, not my favorite portfolio. Holy smoke, is 40% plus in financials, another 15% plus in communication services. Oh my gosh.
And we've got a mix of those in our portfolio. Companies like Capital One, where the durations are shorter, they could probably sell the asset side of their balance sheet for more than book value today. A company like Bank America that we also like because of their strong deposit franchise, they will be under earning for a couple of years because the duration of their portfolio is a little bit longer.
Yeah, Capital One's a risky stock. Risky, in my opinion, in this current stage of the cycle we're in. Capital One usually a company that attracts a lot of younger folks, people that are just getting started on their credit journey. Capital One's always been one of those companies to kind of like get you started. Like I remember my first credit card I ever had was Capital One, and they charged me for some fee, and so I ended up canceling it. I was pissed. Capital One, never had a Capital One ever again since that time period, right? But that's usually like, you know, the company that a lot of people are attracted to for, you know, that it might be lower income, that might just be looking to start building credit, which are always the most risky borrowers, right? Always the most risky borrowers. And so a company like Capital One, I think if you were to see unemployment climb substantially in 2024 for whatever reason, right? I think, you know, a company like Capital One could get hit very, very hard in that sort of scenario, right? Along with just financials in general. The good news with financials, they trade pretty cheap, so the downside's somewhat limited. Bad news is they're so dependent upon the economy. And, you know, if that switches up on them, you know, next thing you know, they have to start contracting credit, right? They start taking big losses. There's a whole mess that goes on in regards to that. So his portfolio, not certainly my cup of tea in my personal opinion. Appreciate everybody joining me as always. Thanks so much for being subscribed, folks. Make sure you check out the pinned comment down there, how I find 10x Stocks Workshop. I put that together for you guys last week. It's a free video. It takes about 28-30 minutes to watch it, and you'll get a lot of value out of that. I can send that over to you tonight. Much love, and have a great day.